Boom! What's going on, Investomaniacs? Your boy, a Knight Rider here. Today we're taking a stroll down memory lane. We're taking a look at Facebook's 2012 IPO and some of their numbers, some of their valuation numbers they had back then, because it's a lot different than these new IPOs coming out, particularly the high growth ones, where a lot of them are losing a whole bunch of money, and what we consider high valuation today and what was considered high valuation back in 2012, little bit different. So this is 2011 data for Facebook for the 2012 IPO. Now, Facebook, first of all, they were profitable, which most high growth companies IPOing today are not profitable. You were paying a PE of 104 for a top line growth rate of 88% 2011 over 2010 year over year data. So that's a crazy high growth rate, and they're still profitable, which is just wow, right? You see that so rarely today, or just in general, to have that high of a growth rate and be profitable at all. And look at their operating margins, so beautiful, 47.3% operating margins. Just for even today, that's such an extremely high operating margins even today in kind of a world where now software as a service companies are regular things. I mean, this really is, and this was back in 2012, but it was just, even today, this is like one of the best operating margins you're going to find, period. Now, a little bit of historical data on what was happening during the IPO. Facebook had just acquired a young Instagram for $1 billion, and a lot of kind of investors and pundits and analysts were screaming, oh, it's overvalued, they're paying too much. Now, of course, in retrospect, we know how that worked out, but at the time, people thought that they were overpaying for it. Snapchat had only just been released a couple months prior to Facebook's IPO, so it wasn't at that time this concern like, oh yeah, Snapchat is the next Facebook, because a couple years after that, Snapchat was really growing really fast, but then of course it did kind of die down, and now it's not really growing so much. But Snapchat was not a concern at this point in time. Users were shifting from desktop to mobile, and investors were unsure if Facebook could successfully monetize mobile. So remember, this is, we are now in 2012, so this is just a couple years after the iPhone was released, and just a couple years after Android comes out and people start kind of getting their phones, and we don't have super fast data at this point. Like YouTube wasn't as popular as it is today and stuff like that, just because the data quality wasn't so good back then. But there was that gradual shift where people were moving more and more onto mobile, but investors weren't confident that Facebook would actually be able to monetize it as well as desktop. Coverage was heavily negative in the media. So we'll take a look at 3 random articles just from Googling like Facebook IPO. Can Facebook live up? This is, by the way, this is from The Verge, so pretty reliable source, or not, maybe not reliable, but respected source, right? Can Facebook live up to its $104 billion valuation? First sentence, Facebook's stock price doesn't reflect its fundamental business. Now, the only way I can interpret that sentence is meaning that it's overvalued, right? And yet by today's terms, it's actually quite undervalued. We would beg to get those numbers today. This is from TechCrunch, an article from TechCrunch. A $104 billion market capitalization puts Facebook at more than 100 times trailing earnings. That's a big multiple to live up to, and it will likely need to add bold new revenue streams to justify the mammoth valuation. Now, they have added, obviously, a lot of new revenue streams, but the truth is all they needed to do was figure out mobile, make sure they succeed at the transition to mobile advertising, but just continue on with monetizing through ads. That's all they had to do to justify that valuation. Another thing I want to point out is this is a very high growth company, but notice they use trailing earnings. Today, trailing earnings for high growth companies, I feel, are becoming less used, particularly on CNBC, and I'm a huge fan of Jim Cramer, But he, I feel, is particularly a person who uses forward earnings a lot and forward numbers, and I believe that's I think it's a little misleading to newer investors who can't quite hear. I mean, even myself, because in my brain I'm always thinking about trailing earnings because that's kind of the way you should be doing it a lot of times. And he just kind of glosses over the fact that it's forward earnings, as do a lot of the people on CNBC, forward earnings. And so I hear it. And I know it says forward earnings, but in your brain, you kind of just think trailing earnings because that's traditionally the way that you hear it. And so I feel that it makes things appear cheaper than they really are. And I really don't like the concept of using forward earnings because the forward earnings don't actually exist yet. It's an estimate that companies miss estimates all the time. Just look at AMD. It's like companies are always missing estimates or beating estimates. It's an estimate. So why are we saying, oh, it's forward earnings as if it's already happened, like it's factual information? So I always prefer to look at trailing earnings because that's an actual fact. That's actual, real, tangible information. One more thing I want to note. When you have I didn't actually do this math, maybe I should have, but it just occurred to me right now. When you have revenue growth at 88%, the difference between 12-month trailing earnings as opposed to, say, last quarter's trailing earnings on an annualized basis is going to be significantly different because it's growing so quickly. So in reality, I would bet if you were to just take the most recent quarter of Facebook's earnings and then times that by 4 to annualize it, you're actually probably only paying maybe like a 70 PE at that point, like somewhere between 60 and 70, because it's growing so dang fast. So it's not actually even really a 104 PE. It is on a 12-month trailing basis, but you can't really look at 12-month trailing earnings quite as the same way as compared to a company that's growing revenues at 5% or 10%, because it becomes so massively kind of comparing apples and oranges. So that's why a lot of times when I look at really high growth companies, I like to just look at the last. Well, I mean, obviously you look at both, but when I try to kind of compare different companies, the higher the growth is, the more important it is to say just look at the most recent 1 or 2 quarters and try and run some numbers for that, because it'll give you a little bit more accurate representation of how much you're really paying for the current earnings. So yeah, even to say a PE of 104 is a little bit disingenuous or misleading because it's growing so fast, you're actually really more paying like 60 or 70 PE. But nonetheless, I did want to point out that it says trailing earnings, but a lot of times today we're using forward earnings. Another article, this is from The Guardian, another reliable, and I think I said that's from TechCrunch. So all pretty reliable sources or respected sources of information. Facebook IPO overvalued at $96 billion, say investors. Poll finds 79% think social media giant's price tag is too high, but it did note that it was already oversubscribed. So, by the way, it says 96 billion because the initial range was at 96 to 104 billion. They ended up on the high end at 104, but they even thought it was oversubscribed at 96 billion. So, it was just kind of overall the media was very negative about Facebook, saying it was just too expensive. Yeah. Now, I do want to say, okay, there are a couple reasons why somebody might not want to invest at IPO. So a couple reasons. One, there was a whole bunch of lockup expirations, like a lot more so than usual. So there was a lot more float going to become available after the IPO because there were so many early investors. Facebook did wait, a kind of long time to IPO. And so there was going to be a whole lot of downward pressure on the stock because there was so much kind of lockup expiration going to be happening. So there were a lot of, and I think that's a genuine concern. So if you didn't want to invest for that reason, I kind of get that. Additionally, there were a lot of people who were not sure if Facebook was actually going to figure out mobile. Now, personally, I don't think I would have been super scared of that. I can't say for sure because I wasn't investing, at least any type of serious money in the market at that point in time, nor did I really understand anything about valuations at that time. But the point is, I don't think I personally would have been so concerned about the transition from desktop to mobile, but maybe I would have. It's hard to genuinely put yourself in those shoes and be like, oh yeah, I'd invest a whole bunch of, I'd put 15% of my portfolio in something when the entire way that they're making money, desktop, is eventually going to die. Because if you believe in mobile and that people are transitioning to mobile and they haven't successfully proven like hardcore that they can monetize mobile really well, then okay, that's a legitimate reason to say you don't want to invest at that point in time. So let's also look at Facebook's end of 2014 numbers. This was well after, so some things that were going on around this time. Facebook had successfully proven it could effectively monetize mobile, and I mean, I gave us a little bit of extra time. So this is a very conservative time to say this is well after they had proven that they could monetize mobile. Instagram continued its extreme growth rate. Facebook had acquired Oculus for $2.3 billion early in 24. Again, everybody was saying they paid too much for Oculus, and Facebook acquired WhatsApp for $19 billion in early 24. Again, everybody was really saying that was so overvalued. They paid way too much, way too much, way too much. And that was going on for years. I mean, for years, people were saying they paid too much, particularly for WhatsApp, because that was a much larger acquisition than Instagram or Oculus. Especially considering Facebook wasn't even monetizing the platform at all. They actually demonetized the platform. WhatsApp was charging, it was like $1 a year, something like that, and they actually removed the fees and just put it up as a free platform. So some investors were very concerned that they paid too much for that. I haven't looked into the detail. I mean, it was a while ago, and for this video, I didn't look into the details of valuation and whatnot, so I can't really opine on that one way or the other. But the point is, that was the primary negative thing. But let's look at some of the numbers. Now that we know that Instagram is blowing up pretty well, and we also know that they have successfully transitioned to mobile monetization. We're only paying a PE of 52.47. And we're getting top line revenue growth of 58.36%. Our operating margins are an extremely strong 40.1%, and earnings per share are up 83.33% year over year, giving us a PEG ratio of like, what is this, like 0.65 or somewhere there around. I mean, our earnings per share is it's over 50% higher than our PE ratio. This is just stupidly cheap in today's terms. And I also did want to show you, because a lot of you are probably aware that Facebook stock kind of crashed for a while after it IPO'd. So remember, its IPO price was, I think it was like $38, so it was around here. It had a quick little peak. These are weekly candlesticks. And then it dipped down to below $20 for a couple weeks. It stayed pretty low for kind of a period of a couple months, but we're still in mid-2013. Just so you know, I'm not cherry picking the date. I mean, we're talking late 2014 right here, the end of 2014. So this is where we actually do the numbers for valuation, because I had to pick end of year because those are kind of the numbers I have. But you can just see, the stock has already climbed from below $20 to about $77. So the stock has already more than tripled off of its bottoms, almost quadrupled from its, actually I think it technically has quadrupled off its bottom. So we're not getting in at like some super magical time. I'm not cherry picking. This is like, you're basically you're investing at its all-time high after it's already grown a heck of a lot, and it's still only trading at 52.5 PE with the extreme revenue growth and the extreme earnings per share growth. Super strong margins, even by today's standards, with all the software as a service companies, crazy strong margins. Now let's compare that to, say, some of the loved high growth software as a service type companies today. Twilio, there's no PE because it's not profitable, has negative 23.7% operating margins, losing a whole grip of money, and it's only growing revenues at 63% year over year. Now, obviously, that's still super strong revenue growth, but it's not as strong as when Facebook IPO'd. Shopify, again, not making any money, right? Losing money, negative 9.1% operating margins. Remember, you compare that to Facebook, which has operating margins in the 40s plus. And revenue growth is at 59%. Again, slower than where today it's considered one of the super fast growers, right? These are two of the most loved growth stocks, but they're so expensive relative to Facebook just not that many years ago. And then let's also compare it to Snapchat, because although people aren't really saying Snapchat is the next Facebook today, not that long ago, people were saying, oh yeah, Snapchat's the next Facebook, Snapchat's the next Facebook. But again, the numbers say differently. Again, PE doesn't exist because it's losing money. Revenue growth is only at 39%. And my goodness, look at these operating margins, negative 93.8%. For every dollar of revenue they gain, they lose 93, or not, I'm sorry, not gain, just bring in general. We're not even talking growth, right? Because they're only growing at 39%. Just every dollar of revenue they bringing in a period, they're losing 94 cents. The numbers prove this ain't no Facebook. This ain't the next Facebook, because all you have to do is compare the numbers. So a note here, I'm not saying this applies to this exact situation, but just a general thing to keep in mind. Companies which are losing money generally need to dilute shares more or take on more debt relative to profitable companies. So revenue growth between profitable and unprofitable companies on a per share basis is even more wide than it would imply. So again, it's, are these really the top line might be growing at, say, around 60%, but because generally speaking, stocks which are losing money, they have to dilute shares, your revenue growth on a per share basis might only be like 50% or something. Whereas Facebook isn't going to have to, or I'm just saying profitable companies aren't going to have to dilute their shares as much. So what can we learn from looking back at Facebook? Times were different just 7 years ago. Back then, we were only a few years off of that 2008 financial crisis, and investors were more risk averse coming out of that financial crisis. They were less likely to pay a higher valuation, even if by today's standards, that would be a very cheap and justified valuation. Plus, the dot-com crash was still in the backs of investors' heads. Most of the institutional investors in 2012 were either investing during the dot-com crash or were old enough during that time to remember the dot-com crash. Because investors had been burned by internet companies previously, they were much stricter with Facebook's valuation. Today, obviously, things are different. Our economy has been in growth mode for 10 straight years, over 10 years now. The 2008 crash seems forever ago. Investors are therefore a lot more willing to take risks because things have been going so well for so long. The dot-com bubble was almost 2 decades ago now, and many of the young both institutional and kind of home buyers, they're too young to remember much about the dot-com crash. I certainly know I am. I can study it, I can see it on paper, but studying something is not the same as actually living through that crash. For this reason, young investors have no aversion to internet stocks. They were never burned by them. However, today, I believe there's a fair chance that there will be a sizable number of young investors who put a large chunk of their net worth into, say, Bitcoin, some cryptocurrencies, some marijuana stocks at the wrong time, and they'll remember that for the rest of their lives. I'm sure there were people putting money in Bitcoin at 20,000 per coin, and they rode it all the way down to 5,000 below, and I mean, they lost 75% of, some of these people are putting basically their entire net worth into Bitcoin, unfortunately. So that's their little internet bubble. The last reason I think internet growth stocks have such higher valuations today is exactly because of the success of companies like Facebook, Google, and Amazon. As these internet companies succeeded, investors began to trust internet stocks again. And in fact, they're seeking them out now due to their potential to scale much quicker than most offline businesses. Similarly, Amazon was that unprofitable unicorn of its generation. For years and years, analysts and talking heads would condemn Amazon because it doesn't make any money. Well, we all know how that turned out. Now, when you see growth companies that are losing money, it doesn't necessarily faze investors as much because we have that ultimate reference point. We have Amazon. Although I've never really thought about it. I mean, the truth is, I know this is true for me, right? I know that, like, I remember periodically watching CNBC as a teenager and in my early 20s, and the talking heads would always bash Amazon, saying how incredibly ridiculous the valuation was. I remember this with Facebook too, right? How incredibly, I didn't really understand anything about valuation at that time, but they're like, oh, it's so overvalued, it's crazy valuation, you know, it doesn't make any money, or it's too expensive with Facebook, blah, 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 blah. But then I would see Amazon keep growing and growing and growing, and Facebook growing and growing and growing, and becoming the cash cow that they are today. That has to have influenced me personally. I mean, if Amazon ended up failing and just losing billions and billions of dollars, I probably wouldn't be as comfortable with money-losing stocks. Anyway, I wanted to share this with you guys and give you a reference point. Today is only a mere snapshot, right? Because sometimes, if you just recently started investing, then paying 20 times revenues, not profits, 20 times revenues for a high growth software as a service company that's losing a whole grip of money, that seems normal. So I thought this would help. I mean, hopefully for you guys, but certainly for myself, to put things in context. And I kind of like this. I'll probably do something similar with like other FANG type stocks earlier on in their lifetime on the public market. Hey guys, I really appreciate the support. I don't really feel like there's enough stock investing content on YouTube, so I'm trying my best to help contribute, and the likes, comments, and subscribe really help keep me motivated. Thank you so much. I hope you guys have a good one.